Hi everybody, welcome to our DAT IQ weekly market update. We're coming to you live today. This is our update for April 15, episode 334. I'm Dean Croak, market analyst here at DAT Freight and Analytics. I'm in Portland, Oregon, and I'm also with our special guest today, Tim Denoyer, who's in San Diego. Welcome to the show, Tim.
Great to be with you, Dean.
Yeah. What's happening in San Diego?
I'm down here at the Lytics Protect conference. It's a customer meeting. They had some news just yesterday with Geotab, which is a partner of theirs. They're combining Geotab's telematics with Lytics's video safety platform. So I'm hanging out with a lot of safety professionals from fleets, and I get to speak after Coach Brian Billick of the Baltimore Ravens a little later today.
Right.
Tough act to follow.
Yeah, quite the card. Tim, for those that don't know you, and I'm sure there's very few, but for those that don't, tell us a bit about yourself and what you do at ACT Research.
Sure, thanks. I'm a senior analyst at ACT Research, and I focus on commercial vehicle forecasting and freight market and freight volume and rate forecasting as well. I do a lot of used truck price analysis and forecasting, so a lot of just data analysis around the commercial vehicle markets.
What a time to be in that space. We'll talk to you a little bit about that later on, especially on the new truck and trailer order side. So, all right, we'll bring Tim back a little bit later. Let's dive into some of the key trends we're watching. Unusual events last week. This theory I've been advancing for the last 12 months was evident last week, very much so. The market is still flush with latent capacity that we've observed sitting on the sidelines when demand is soft, but dives back in when there's a demand surge, like we're seeing as shippers try to head off tariffs. Rates fell across the board last week, yet the loads moved on our network were the highest ever recorded for week 15, even higher than the peak of the pandemic in late 2021. So lots of volume moving, but still lots of capacity to keep a lid on rates. Other data points you're watching, March US imports came in up about 8% month over month and 11% nationally. But on the Trans-Pacific trade lane with China to Los Angeles in particular, volumes dropped about 21% last month. Global Port Tracker predicts US retailers who rushed to get goods in ahead of escalating tariffs are starting to pull back on new orders. They forecast volumes will be down about 20% in May at a time when volumes start to typically rise. Other data points that kind of support that, they're not linked, and I think will become a big story is intermodal, especially on the West Coast. There's a downward move to start off the second quarter, according to Larry Gross. But the full effects of the trade war are still several weeks away. National intermodal volumes were down about 3.3% last week, steadily dropping on the West Coast as that 2025 import surge starts to unwind. Tim will talk about North American Class 8 truck orders trending below year-over-year levels. More from Tim later. Diesel prices destined to impact flatbed markets in the US. Are the dropping oil prices in particular. US energy firms cut the number of oil rigs by the most since June of 2023 last week, down about 7 rigs. It's about 34 lower than last year. That means a lot less volume for flatbed carriers in our biggest flatbed spot market in Texas. Diesel did drop though, so that's some good news for carriers, down about 6 cents a gallon according to the EIA. West Texas Intermediates hovering around $62 a barrel this morning. So a little bit of a rise. It was in the high $59 mark last week. This week's market update, we're looking at the Logistics Managers Index from Zach Rogers. Turnaround day, interesting story about the Port of Miami when all the big cruise ships come in and out on the Saturday. A lot of freight volume moves in and out of that market. And of course, more on the impact of drilling rigs in the Permian Basin. Let's have a look at our load to truck ratio, and starting off with dry van. After increasing for the last 3 weeks, load post volumes plunged last week by 24%, still 11% higher than last year. Load to truck ratio down about 25% to 4.05. In the refrigerated market, after surging by 22% the week prior, reefer load post volumes cooled last week, dropping by a massive 27%. On the back of a 16% drop in North American produce volumes last week. We're seeing lots of volume fluctuations in produce, mainly because of the surge in Mexican produce imports through the McAllen market. They dropped 32% last week. a lot of volatility has been driving the North American market, mostly by Mexican imports that were coming in looking to get ahead of tariffs, which of course didn't eventuate last week. Load to truck ratio down to 7.11, and in flatbed, load post volumes were down 13% last week. Open deck demand is beginning to flatten. Volumes are still 23% higher than last year, though. But definitely the market is cooling. The load to truck ratio ended the week at 36.28. That's down about 20% week over week. Having a look at our year-over-year look at spot rates, line haul rates in dry van, these are excluding fuel, down by just under 4 cents a mile last week. The national rolling average for 7-day rolling average paid carriers an average of $1.62 per mile. Load volume, though, loads moved, was up 17% last week. At $1.62, rates are about 5 cents a mile higher than last year, at about 9 cents a mile higher than where they were in 2019 and 2020. In our Midwest region bellwether states, there's 13 of them, which account for 46% of our loads moved nationally. They also have the highest correlation to the national average. Carriers were paid an average of $1.83 per mile. That's 21 cents a mile higher than the national 7-day rolling average. But the Midwest region states, rates were down 5 cents a mile last week. Volumes were up 18 cents or 18%. And in refrigerated, capacity loosened slightly last week. Rates were down by a penny per mile to $1.88. Volumes were up 11% in terms of loads moved. Flatbed, after registering 9 weeks of gains, flatbed spot rates reversed course last week, dropping by 2 cents a mile to a national average of $2.16 a mile, pretty much as Ratecast has been forecasting for the last month, and that was that the flatbed early season peak was going to flatten out, which it has. Compared to last year, flatbed line haul rates are 17 cents a mile, or about 8% higher than where they were last year. Let's have a quick look at our short-term forecast. This is our Ratecast forecast out 35 days for line haul. Loads moved over 550 miles, excluding fuel. This heavily weights seasonal trends as opposed to short-term fluctuations in the market, such as what we're seeing here around tariffs. So let's start off with dry van. We're seeing a slight deterioration this week. Ratecast is expecting rates down 7 cents a mile to $1.53 out by May 16. That'll be about 7 cents a mile lower than where it was last year before we start to see this inflection driven by produce season typically. We're hoping that holds and we don't see the worst case scenario there in red, which is the lower case. That expects rates could be down as much as 14 cents a mile by the middle of May. In the refrigerated market, Mother's Day shipping ahead of Mother's Day on the 11th of May, and some early produce volumes are coming into the early May forecast. Ratecast expects rates to bottom out at $1.80 a mile at the start of May before the produce season begins, and ending that 35-day forecast range on May 16 up about to $1.87. That'll still be 7 cents a mile lower than where it was last year. And in flatbed, Ratecast is expecting rates flat out to May 16, dropping about 2 to 3 cents a mile to the start of May before picking up towards the end of the forecast range, ending that range at about 2.18. That will be an amazing 14 cents a mile higher than this time last year. All right, we don't have Chad with us today, so let's bring Tim back in. Tim, question of the week, pretty easy one for you to answer. Now we have a clearer direction on tariffs, maybe not. What can the trucking industry expect?
Yeah, it's a great question. So we have some more certainty, but I'd say there's still a fair amount of uncertainty about the 90-day pause that's going on at the moment. But what we do have from a certainty standpoint is not good. I guess is the way I would suggest. We recently lowered our economic forecasts just earlier this week, just yesterday. Sorry, and we're at sub 1% GDP growth for this year. We had been coming in this year at the 2.5% to 3% range, which is where growth had been trending. So we've revised it down quite a bit. We're not quite at a recessionary forecast yet. There's certainly still a lot of risk because of tariffs, and we think that it is a very significant piece of the freight market. Our estimate is international trade is something like 20 to 25% of freight demand, and certainly, as you pointed out, with intermodal, it's more like half. It's a much more significant piece, and so that is the imports in intermodal is where we'll see it first. But it's going to be a broad hit to freight demand, and so I can't argue too much with the rate cast downtrends here. But I guess what I would add is it's also negative for the supply side of the equation, and so that actually adds there's an inverse relationship with rates, and so that actually makes the rate outlook relatively resilient in my mind to tariffs. And so while there's certainly some headwinds, there's also some tailwinds, and so there's going to be lower supply. We recently also lowered our Class 8 truck production forecasts for this year quite a bit as a result of tariffs, and even with the 90-day pause and the exemption of the USMCA vehicles or USMCA product in general, we still think that with the tariffs announced, we're going to have something like a mid-single-digit kind of cost increase on Class 8 trucks. So something like 5%. We don't know exactly, but that's a pretty big increase in the cost of new trucks, and so it's probably going to be negative for demand for new trucks, and so it's not good for the manufacturers, but that will have a tightening effect on capacity, which not immediately, but eventually will have a positive effect on rates.
Tim, talk through where our trucks are made. So talk about Class 8 sleeper cab trucks. Some are made in the US, some are made in Mexico. What's that split look like?
It's roughly 2/3 US, 1/3 Mexico. It was about 34% were built in Mexico last year of the trucks that were sold, the tractors that were sold in the US. And so, so far those costs are going to be spared some of the biggest tariffs of the 25% or more type numbers. But under USMCA, the rules are somewhere around 60 to 70% local content. So there's still some imports of goods happening. There's still some steel and aluminum tariffs. And so we think the U.S. manufacturers are actually going to get hit a little harder here than those being assembled in Mexico for a while now. This is a quickly changing situation though. So, but yeah, about 1/3 are coming in from Mexico.
And I think we ship about the same volume of used trucks to Mexico. Will they be caught up in this also?
The used truck, I believe there is a tariff already. I don't think it's been changed as of yet. It's a relatively small tariff on used trucks. But Mexico takes something like half of our used trucks, and it's a relatively small number. It's something like 10,000 a year. But it probably will come under some pressure, in part because the dollar strengthened a lot versus the peso.
Right. Last time we had you on, you talked a lot about the private fleet growth. You and I talked offline about day cabs in particular. Are you seeing any change in those trends?
Well, that sort of brings us around to truck orders, which is one of our the topics we like to discuss a lot. And the last few months really have changed since the last time we talked. I believe we talked after the election, and there was still some euphoria in truck orders, and there were some strong numbers in November and December of last year. But the first 3 months of 2025, I guess I would say, has been marked by uncertainty, and so orders have come down quite a bit. No one's canceling orders as far as we can tell, because demand for those pre-tariff trucks is going to be strong, and I think we may well see an uptick in Class 8 tractor sales in the next few months, reflecting the sort of a pull forward ahead of tariffs. But notwithstanding that, the tractor sales have come down below replacement for the past few months for the first time in since the pandemic. So in a few years, and so capacity broadly is contracting for the first time in a long time. And I hear you when you say there's latent capacity still out there, and absolutely, and it's going to take a while to sort of work through that. But from new additions to the fleet perspective, the new truck sales are below what we sort of need for maintaining the fleet size. So just by a little, but I think that tells us that private fleets have effectively stopped growing, and so when we do get back to economic growth, that should be a good sign for higher demand and spot demand.
Yeah, I was looking at our data this week for replacement rates on new rates entering routing guides for the first time. And in the dry van market, replacement rates are coming in, and this was data up until the last couple of weeks, were coming in about 0.1% up, so essentially flat.
Mm-hmm.
These are new rates based on recent RFPs. They were up about 3% in the 2 week prior to that, sort of at the end of March. Temp control reefers up about the same, about 0.5 percentage points, which is essentially flat. So new rates coming into routing guides, pretty much flat for both dry van and reefer. So no upward inflection, but no serious downside either, which tells you that capacity is largely matching where demand is on the large fleet contract side. Flatbed, very different story though, Tim. Rates are coming in about 8% lower, have been doing so all year. So there's a lot of excess capacity in the large carrier flatbed market, opposite to the spot market where capacity is very tight and rates are going up, or have been. So I think you're right. I think there's we are seeing right now that we've got down to what you could call equilibrium, I think, in the large fleet contract market. If you look at rates being negotiated in routing guides as a proxy for where supply is, it certainly looks like we're at the bottom of that curve, but we're not seeing any meaningful upside yet. Now, that said, we haven't seen all of the new rates based on RFPs that have been conducted late last year enter our routing guides completely. So I expect pick up, but we're certainly at the bottom of this. It must be difficult for fleets, though, to project where this is going to land in terms of how many trucks they need to order. It must be one of the toughest things they're faced with this year.
Yeah, absolutely. And I think the short-term answer is, unfortunately, if you haven't ordered the equipment already, you're not going to get the pre-tariff price. So that ship has sailed. So yeah, the fleets are going to be faced with the higher costs of equipment from here on, and so that's a headwind to capacity additions broadly, not just with for-hire fleets, but private fleets as well. And probably one of the bigger issues that we're struggling with is that the EPA rules that have been driving a lot of purchasing of trucks over the past few years are now in question.
Right. That was going to be my next question. The EPA 2027 pre-buy, has that largely disappeared, or you're not sure?
Well, so the demand level for this year suggests that we're not pre-buying anymore, or perhaps even we're giving back some of the pre-buy from the last 2 years, given where demand is today. And so that's we still think there's likely to be one in 2026. The current the way ATA is positioned, I think ATA is kind of leading the charge here in terms of the lobbying organization that sort of running the show. I think that the position is they really want to address GHG3 in a more aggressive way. That starts in 2027 and sets some pretty unrealistic targets. So that's sort of the first priority. But the low NOx rules, the clean truck rule that has really been driving the pre-buy. That's more likely to just get revised as opposed to entirely pushed out and reevaluated. So they're both likely to be changed. But what we're hearing is that there's some really costly warranty and useful life provisions in the EPA 27 clean truck rules, the low NOx rules, that are most of that $20,000 to $25,000 cost increase that is expected. And so that looks like it's going to be addressed. They may keep some of the emissions improvements, which are going to be low costs and already well underway from a manufacturing perspective. And the engine makers have engines that are at least close to that already in California. So but the EPA rules are very much in question. And if it does go away entirely, then the pre-buy likely would as well, which would be positive for freight rates.
I've got an unstable connection here, I think, so I'm not sure if I'm coming through okay, but that was one of my big questions. We've got a couple of questions in here from our chat, Tim. Nick Patel, what does the truck resale market look like?
Good question. This one's a fascinating one right now. It's moved up a little early this year, and given the tariffs are essentially a cost increase for all equipment in the way I see it, and so we've been bottoming for a long time. It very much looks like what's been happening with spot rates over the just and used truck prices tend to lag by a little bit. So it hasn't improved much, but it's improved a little, and there, I think there's some near-term impetus for higher used truck prices because of what's happening in terms of the cost increases on new trucks, and so that I think is sort of a interesting dynamic here in the next few months. That looks like it's going to continue to go up. Would be my guess, but of course there's a lot of economic headwinds to deal with at the same time. But I think that's a really interesting one to watch. But early gains there.
Auction inventory, have you been tracking any changes there in the number of vehicles heading to auction?
To be honest, I don't have a great sense of the inventories. We have been impressed with the auction prices overall. I don't off the top of my head have a great sense of inventories, but my guess is that the tariffs and the lower new truck demand, and if we look back 3 or 4 years, which is where a lot of these, maybe the 3 or 4 year olds aren't heading to auction, but where a lot of the supply in the used truck market is 4 or 5 year old trucks. 4 to 5 years ago, we were not building that many trucks, and so that is going to suggest that there is an underlying tightness there.
Yeah. Another question we've got from Dr. Daryl Cooper Jr. Have we seen an increase in truck losses or bankruptcies due to the recent economic shifts, and what trends are we noticing with owner-operators or small fleets struggling? I can maybe sort of set that discussion off. Yeah. We don't have very good bankruptcy data, never really have. But what we are seeing, though, is that for the first time in 22 months, the number of carriers entering the spot market has outweighed the number of carriers leaving. So we've been losing capacity in the spot market pretty consistently since October 2022. It's almost back to positive. How long it remains there, I'm not sure. So that capacity shift looks like it's starting to get back to equilibrium. What we are noticing, though, is that operating costs are still about where they were in the last year, about $1.80 a mile. If you draw a line across the last 6 to 7 years, we're about 16 cents a mile higher in the small fleet side of the business than where we were in 2019. So it's costing more to run a truck. Carriers are still breaking even. Rates for carriers to be really profitable, they need to be up around $2.20 a mile. They're not. All-in rates are about $2 a mile in dry van right now. So we're not seeing the sort of rate increase that would sustain a healthy level of fleet viability longer term. So we're still not there yet. I think a lot of fleets have been struggling. If you follow the media, there's still a lot of carriers that are going out of business. I think a lot have been on the ropes. We were seeing an improvement, though, Dr. Cooper. In December, we were seeing things improve. Early January, we had a boost from the colder weather. So things were on the up when we got into January, and there was a real sense we were coming out of this freight recessionary period and things were going to improve. Of course, that all changed dramatically. And I think after this period of volatility, we're seeing where a lot of shippers are moving a lot of volume and getting it into position ahead of whatever other tariffs there may be resulting from this sort of fluctuating trade policy environment. I think we're going to see a much slower freight demand for the rest of the year and fairly flat rates. That will put a lot of pressure on carriers that have been struggling. Tim, what sort of thoughts do you have on that space?
Yeah, I think I would certainly agree with all of that. I think in terms of the truck losses or bankruptcies, I am a little concerned certainly about that increasing as freight demand goes through the economic headwinds. I think that was sort of the crux of the question is, I don't think the recent economic shifts have had much impact yet, and it may certainly take quite some time for us to really feel the impacts. A lot of the prices are not going to be passed through immediately. There was a lot of pre-tariff shipping that companies did to at least reduce the impact this year, and there certainly will be impacts, but I think it's going to take we think some of the biggest impacts are not really going to hit until later this year, early next year.
Yeah.
And so we aren't really seeing it yet, I guess, is one way I would answer. But there's certainly a lot of risk out there from a demand standpoint.
Yeah, I think if demand falls off in the second half, we've seen a lot of shippers have a lot more volume moved in the first quarter. One of my carrier friends in Canada, they had their best quarter ever, January, February, March, moving steel from Canada to the US. The problem is that their shippers have been leasing additional warehouse space. So they have plenty of inventory. In fact, so much so that they have enough inventory to last them the rest of the year if demand cools off.
Yep.
And that means there's no more freight haul. So.
Well, and I think we may have a few more months of decent demand as a result of not just the pre-tariff shipping, but now the consumers are seeing the tariffs and saying, well, it's probably a good time to upgrade an iPhone or get a new computer before the price goes up. And so there's going to be pretty brisk demand from that for a little while longer. But after we get through that, those are not good things for freight demand.
Yeah. Talk about the CAS shipment report, the index that came out. You're the author of that. A lot of people might not realize that, but you're the author. Talk to us about the latest results.
Yeah, sure. I've been writing that report for almost 5 years now. Yeah, it's the CAS numbers have been in freight recession now for 3 years, I think. It was really early 2022 was the first year-over-year decline of the cycle, and so we're into the fourth year of it, and the March numbers that we put out just yesterday were down about 5% year-over-year. Again, the freight recession continues from a volume perspective, and so sequentially things were pretty steady. But yeah, I'd say that's one takeaway from that. The truckload line haul index, like you were saying, in terms of contract rates, had been gaining a little bit of momentum, but pulled back just a touch in March, and so that sort of little bit of a near-term loss of momentum, which is consistent with a lot of the rate data that we're seeing at the moment. But yeah, we do need more freight to come in on the. We need economic growth to be rising, and we're sort of firm believers that attacking free trade's not gonna help us to get out of this freight recession anytime soon.
Yeah, March, we kind of March is sort of the makeup month. It makes up the quarter. March didn't produce stellar results for a lot of carriers. Of course, it's earnings week in the investor market this week, so I'm really anxious to hear what some of the large truckload carriers have got to report. But I think the challenge is that March kind of sets up the second quarter from profitability perspective, but we're entering the second quarter with not a very good outlook. So I worry about what the second half looks. I think that's going to be really interesting. Bigger stories that could emerge if we have a massive trade war with China and we essentially shut down imports. Think about all of the intermodal infrastructure that's been built around Los Angeles to Chicago. It's the Port of Los Angeles folks said about 70% of imports that come into Los Angeles go east of the Mississippi. We know that about 30% of intermodal volumes on the LA-Chicago lane. So think about the infrastructure that's already been built around on-dock rail out to the Inland Empire, and then all the transloading that occurs. We have a trade war where half of the imports that come into Los Angeles are from China every month. There's a big dent going to be left in drayage capacity, short haul, medium, regional capacity. That's going to be a very interesting market to watch once we start to see the downturn in imports.
Yeah, I imagine the load to truck ratio for Phoenix by itself is not looking nearly as good as the rest of the country at the moment. But and that Phoenix to LA lane is a particular one to focus on. I would certainly agree. I think. One other thing, it's not obviously sort of the base case of our forecast, but something that we're worried about quite a bit is the situation in Taiwan, and we know that a lot of those chips that we use, modern trucks use a lot of chips, and if anything happens to that supply, like it did back in 2021, the cost of trucks could skyrocket, and that could also have real major impacts on freight markets. But But that would be, it'd be a real supply shock.
I just pulled up some data on Los Angeles, Phoenix. Of course, for those that don't know, it's the home for a lot of imports that go out to the warehouse market in Phoenix and then get set for fulfillment. Rates are down 11 cents a mile year over year, down 7 cents in the last week. Volumes are up though, so there's plenty of capacity on that lane. Normally rates, by the time we get to this time of the year, rates are on the upswing, but they're heading in the opposite direction right now. They're at $2.48 a mile. Normally this time of the year, they'd be up around $2.70. So that lane is starting to cool off in terms of rates, largely because there's already an excess capacity on that lane starting to emerge. So I think we're going to see a lot of capacity on the West Coast emerge as this goes on if we start to see this trade war develop into much lower import volumes.
Right. Yeah, which looks quite likely. Yeah, it's hard to see imports do anything but drop from here.
Yeah. Anything else you want to throw in, Tim, before we wrap up?
I think we covered a lot of ground I wanted to cover. I appreciate your insights and analysis.
Yeah. How can people contact you though, Tim, if people have got questions?
Oh, sure. Actresearch.net is our website. You can obviously get us on LinkedIn, and my email address, I'll just throw it out there, is tdenoyer@actresearch.net. So happy to answer any questions. Yeah.
Okay. All right. Thanks. Great to have you on as always. A couple of shout outs on next week's, or I think on this Thursday's Freight Vine podcast. Professor Kaplis is talking to Dr. Jose Martinez. He's a research scientist at MIT. Next week's show, we have our very own Carrie Jablon talking about the transition. Road Check Week is May 13 to 15. Keep an eye out for that. We'll definitely see some movement in capacity that week, as we always do, maybe less so this year because rates are so low. Make sure you set up alerts for our live show, subscribe to our channel, and with that, another show is in the books. Thanks, Tim. Thank you for watching, everyone. Be safe, be nice to everyone, and we'll see you here next week at 10 a.m. Eastern, 7 a.m. Pacific.